Good afternoon, everyone. I'm very proud and happy to have Philip Petursson join us on this call today. Philip joined IG September 20th of 2021 in his new role as the IG Chief Investment Strategist for IG Private Wealth and IG Wealth Management. His last role was with Manulife as Chief Investment Strategist and Head of Capital Markets. His research, he was responsible for building and managing the capital markets and strategy team, providing the research to formulate investment and asset allocation recommendations to advisors. Philip works with an investment product team that he's just assembled. He's got a team of two other associates that are working with him. And most recently, got to congratulate you, Philip. You were promoted on June 28th to be the portfolio manager of iProfile Investments.
Yes, thank you, Brian, and thank you for having me here. I really appreciate the opportunity to speak to you and all of your clients.
Thank you very much. So client statements are coming out. You and I had a conversation, hey, at the beginning of January, what was 2022 going to look like? Here we are, we're 6 months into it. Clients are getting their statements, and we know the statements are not the way they'd like to see them. We've experienced some things in regards to the markets, not just on the equity side, but also on the fixed income side. And as we know, fixed income investments usually are mortgage bonds, mortgage funds, bond funds, our real property fund, and then high yield investment bonds. We've seen in statements this year being down negative 11%, equities being down, not as much in Canada as in the US and globally. Maybe you can give us some update on what's taking place and what has fueled that as our clients open up their statements now.
Absolutely, and I would echo the sentiment. I mean, the first half of 2022 certainly has been disappointing in terms of performance. Followed a very strong year for 2021, where equity markets were up substantially in what was a great recovery. But really, I would say the first half of the year resulted in a situation where there was no place to hide from the equity market volatility. Now, one fed into the other. So the reason why we saw the bond markets underperform like they have, being quite disappointing in terms of their performance, is because inflation remained quite high. If you remember last year, we had this transitory inflation story, and that the Fed and the Bank of Canada was trying to feed the market, but it was a fallacy. Inflation was going to be stickier, and that has proven to be the case. As a result of that, interest rates move up. So we came from 2022, from a period of very low interest rates, to a period where interest rates were moving higher, and low meaning 0 to 0.5%. So when you're in that situation and rates move up, the price of the bond falls. Just like the price of the bond moved up when we went from 3% in 2018 to 0. So this was just a reset, as uncomfortable as it is, but a reset to realistic rates for the interest rate environment. But when that happens, that also feeds into valuation, the stock market valuation. So when inflation moves higher and interest rates move higher, valuation on stocks moves lower. And that, I would argue, triggered the correction that we saw in the first half of the year in Canada, bear market in the United States, bear market for the NASDAQ, and corrections for other areas around the world. So it was a case of one led to the other and left you with no place to hide.
And that being said, I know on the fixed income side, we have strategized and used other financial instruments to get better returns for our clients to protect the downside. And on the call today that you and Todd Asman had to all the IG consultants, you guys talked about the real property fund as part of that. And that fund was our second best performing fund on the first 6 months of this year, and you take a look at over the last 12 months, it's averaged 16%. I know there are other financial instruments on private equity lending that maybe you can talk about how we are bolstering the fixed income component to get better returns and stability for our retired clients.
Certainly, and when we think about fixed income, it does extend beyond just bonds. It does extend beyond Government of Canada bonds, corporate bonds, high yield bonds, and so on, into, as you mentioned, Brian, real property. So a real property fund owns exactly that, real property on commercial and industrial property across Canada. Private debt, which is private lending, effectively lending to corporations and businesses privately as opposed to being publicly traded securities, and private equity, taking private equity ownership in companies that are at the early stages of growth. And what you tend to see from this is it does provide attractive long-term returns, and in particular with the real property fund, is an offset to rising inflation, for example. And this would we would say is that real estate does better in a higher inflation environment. It tends to be positively correlated with inflation. It's an inflation hedge, and that is part of the reason why it has done so well, and also why it is in the portfolio.
In that, so that can leave, for our clients to know that we are not sitting back. You as a portfolio manager and our institutional fund managers are looking for the opportunities, because the clients are saying, I got my statement, I'm down. These are the professionals. Brian and his team have been doing this combined years of experience, or over 50 years. You've been in this business many, many years. You've experienced all these downturns, the dot-com, 9/11, the 09 credit crisis, COVID, where we saw, the fastest bear market ever in history, starting in February and then turning around at the end of March. And we know that markets do recover. Markets are positive 75% of the time, negative 25% of the time. So what we need to do is, our job as financial planners is to create wealth, maintain it, and preserve it in using financial plans, taking account into inflation in that, and letting the portfolio managers be the ones making the decisions on the exposure of where do we invest this money. Maybe you can give us some light in regards to clients are basically saying, what are the IG institutional money managers doing now with what's occurred in the last 6 months?
Sure, and I would almost say, what do they always do? It's not necessarily that a light goes off and say, okay, we need to now shift the portfolio to this, or we need to. It's an ongoing exercise within the portfolios that each portfolio manager will have their process that's been developed over time and proven over time that they have found effective within their universe, whether that be Canadian stocks, US stocks, international stocks, bonds, whatever it might be. And so every day, the portfolio manager is reevaluating their portfolio based on the market moves, based on the new data that comes in, whether it's economic data, whether it's company specific data, whether it's competitor data, and they will make adjustments where necessary to the portfolios to constantly shift the portfolio to the better relative opportunity set, is the way I describe it. We want today to have the best portfolio that we think is going to deliver for our clients over the coming 6 months, 12 months, 6 years, whatever it might be. And as new information comes in, things change. Company results might disappoint to the downside or might surprise to the upside. That can change the allocation within the portfolio. So it's not, Brian, that oh, I think a recession is coming, okay, let's wholesale shift the portfolio to be more defensive. It's incrementally the portfolio managers will see signs coming from the companies that will let them know, you know what, there's not such a great opportunity set out there. Maybe, or what I want to do right now is take up my cash weight, which we're seeing in some portfolios, take up my exposure to the defensive stocks, utilities, communication stocks, for example, or in times when things are booming. Well, I want to own more technology. I want to own more growth names. I want to own more cyclically oriented companies. So in this environment, though, let's bring it back to what's been happening today. You've seen a lot of the managers shift their portfolios to be a little bit more, I would say, managing of the volatility, right? So we recognize that we don't want to have portfolios that whipsaw our clients around. So if we could manage the volatility within the portfolios, position ourselves to cheaper areas of the market, take advantage of that. On the fixed income side, what we've seen, our portfolio managers have been recognizing the attractiveness of corporate bonds that are paying. Investment grade corporate bonds, for example, are yielding at almost 5%. High yield corporate bonds are yielding 8.5%. Well, that's fairly attractive. So, maybe we should embrace that, especially if we think the risk of recession is still fairly moderate or to low. So that is what happens. It is an ongoing process where the portfolio really is a steamer ship out at sea, and it's slowly navigating the waters, as opposed to a speedboat, skimming across the water.
Awesome. I think that gives a reassurance that it's not a one-time event. It's a long-term event and strategy as they're looking at these things. Now, in the news, Canadians are being inundated with the social media headlines and posts that make this downturn feel so much more different than what we saw in years past, and even back in what we saw happen just in 2020. So I know you are a student and you study behavioral finance and that. And as clients get their statements in June of this year and they see this downturn, we know their emotions and that. Maybe you can talk about behavior finance and bring some light to that for us as well, please.
Absolutely. And this is an aspect of the market that I'm fascinated about, which is the psychology of the investor. And what the new research has shown, Brian, is that an investor feels a loss 5 times greater than a gain. And in fact, when the mentality shifts to that loss mode, the part of the brain that is recognizing or attracted to gains is shut off completely. And so this is why I think it's not surprising to see that retail investors today have been selling out of stocks, mutual funds, ETFs, and moving to cash. Historically, though, they do that at the wrong time. Investors tend to do that at the bottom of the market. We saw this in March of 2020. We saw this in December of 2018. We saw this in March of 2009. We can go on and on when we saw this. So, in fact, if we use the investor as a contrarian indicator, when they are the most pessimistic, when we're getting the calls from our clients saying, I think we should sell, I'm really worried, I've never seen it this bad, when the environment actually is pretty good. Unemployment in Canada, 4.9%, the lowest it's been since Statistics Canada has been keeping that data. That's not bad. It just feels that way because of the way our brain works, the way we're wired. But in fact, this is the time that we should be taking advantage of some of the market dislocations.
And that's where a true written living financial plan is so important in what we do for our clients. And that you can't look at just a 6 month snapshot. You got to look over a period of time. Even for the retirees, as you look forward, I like to put them in my DeLorean and take them to the future. As a certified financial planner, we have to have the plans going to age 90. And one of the risks out there today is people outliving their money. So how can they be making sure their money is keeping pace with inflation? In the plans, we used to be using 2%. Now we're going to about 3%. Inflation will come down. Maybe you could talk about that. It's right now it's the rising costs. What's caused this, and that maybe you can elaborate a little bit more on inflation, what you see happening going forward in the future here.
Sure. Well, I think inflation is going to moderate. We're starting to see signs that inflation might have peaked out. It's not moving up as fast as it was, say, early on this year. There are signs that indicate that inflation should start coming down. Oil prices are down, copper prices, base metal prices, lumber prices are down 40% year to date. So we're starting to see some disinflationary pressure work its way through. In part, that's being offset by higher wage inflation, but that's not necessarily bad inflation. That's actually good inflation because that's more money in the pockets of consumers. Bad inflation is oil, where it's more money out of the pockets of consumers. So with oil prices moderating and wages going up, we do expect inflation to slow, still remain above 2%. But we're going to get to, let's say somewhere between, I think we can get to 5% by the end of the year, maybe 4 to 5%, and then it can continue to moderate into 2023. What do we do in this environment, though, Brian, is the trickier thing. While it seems unnatural right now because equity markets are down back to levels that we were at last March, one of the better long-term hedges against inflation is equities. And one of the better ways to ensure that we do not run into shortfall of our capital in our retirement years is to maintain a good weight, a healthy weight to equities. The old adage of as soon as you retire, you need to de-risk your portfolio. Well, in a world where interest rates are right now below the rate of inflation, that doesn't seem like a very attractive prospect. with the view that equities can continue to outperform inflation over the long term as they have, you still want to maintain equity exposure even well into retirement.
Very good. You brought oil up, and I live in Fort McMurray. We have the oil sands, as you and I know when we had dinner together a month ago. We got companies, Suncor, Cenovus, CNRL. We produce with the oil capital of Canada, and we're producing the oil. Where do you see the resource industry and that going into the future, and the price of a barrel of oil and the impact that has on the Canadian GDP, etc.?
Certainly. So I recently revised my target for oil higher over the course of the next 6 to 12 months, up to the range of 85 to 120. The reason I did that is the view that one, oil supply globally is still fairly tight. Part of that is the sanctions against Russia and the war in Ukraine, but part of that is just the lack of investment that we've seen in new oil production over the last 5 years. It's been very limited. In fact, if you look at the U.S., they're still below the peak of oil production pre-COVID. So that continues to contribute to a tight global oil market. I think if once we get out of this slow patch and the Chinese economy starts to reaccelerate and the European economy starts to reaccelerate, that we can continue to see the price of oil move higher. Now, it's not going to be up 40% year over year, but is it up 5 to 10% year over year? Yes, I think we can see that. I caution this because long-term views are not necessarily my expertise, but I do believe that we are in the start of the next commodity supercycle, just because supply is so tight across, as I said, oil, but across base metals as well. So I think Alberta will continue to do quite well. When oil prices are up, it's good for the Canadian economy. It's good for the labor market, and it's good for the TSX in particular, given that the energy sector is still close to 20% of the TSX index.
Excellent. Now, I know there's been an exodus. Investors throughout Canada and internationally are leaving the markets, and this is when the opportunities are present. For people that are sitting on cash, a lot of people are reverting back to GICs and safer instruments. I know in our call today, we with IG Wealth Management have the highest HISA accounts paying, I think, 2.05% on an account, and if it's over $1 million in assets, we can get them up 2.35. With the Bank of Canada forecasting a 0.75% hike tomorrow, those rates are going to go up. So we as IG Wealth Management can handle cash reserves that clients have, and when they're ready to redeploy that money, in our conversations we had this morning, is not go and just put it all in at once, but maybe dollar cost average in so much per month, maybe over the next 6 months, to take advantage. Can you elaborate on that?
Yes, with cash and the considerations of investing in the market, there are two approaches to go about it. Once you have cash, you can just invest it in the market, but you are subject to whatever that market value is at that point in time. Brian, we know we can't predict the markets over the course of the next month, 3 months, 6 months. The trends over the next year to 2 years are a little bit easier to identify. So what is a more palatable way of investing in the market is by staging it in over time. Set yourself a timeline of, say, 6 months. Over the course of the next 6 months, I'm going to invest so much every month. And if we were to see a correction or more downside, well, I can move more into the markets, but at least I have a goal that over the course of the next 6 months, I will be fully invested. This is important because we often say, look, bull markets can be very cruel. Often when the markets start to rally, investors say, well, I'll wait for the next pullback. And you can have periods of a year, year and a half without any meaningful pullback where you can miss significant gains. So it's better to stage it in over time. You'll capture any downside if there is any downside. If it only goes up from there, at least you'll be fully invested over the course of that 6 or 12-month period. It provides some peace of mind, and it provides some discipline, where otherwise investors are very reluctant to pick the optimal time in the market, and it's human psychology. The optimal time is when the markets are down 20%. That's when it's like, okay, you know what? Markets are on sale. They're cheap. We should buy. But as soon as the markets are down 20%, clients are worried that, well, what if it falls even further? And so that's where discipline comes in place. Dollar cost averaging is a great way to set up a disciplined investment program.
Excellent. Now, I know you are a regular featured person, a moderator on BNN, talking about the markets, the economics, and policy developments of what's taking place. Um, what's your take? Do you feel we are in a recession? We know recessions are going to come, and they will. That's all part of history and cycles. And where do you feel we are? And I know you're a data-driven manager. Give us that information of what you see for kind of looking forward the next 12 months.
Right. So I don't believe we're in a recession right now. I don't believe the U.S. is in a recession. However, I think there will be headlines saying that the U.S. was in a technical recession where that means 2 quarters of negative GDP growth. But what drove that negative GDP growth was exports. Exports were down meaningfully in the United States in the first quarter, and I think we could see the same thing in the second quarter. But is that a broad-based economic recession? Well, I would say no. That's more of an export recession. The reason why I don't think we're in a recession is because, well, I've been through an airport, I've been at a hotel, I've been at restaurants, I've been through the malls, and it does not look like there is a recession at all. Unemployment, yes, it can be a lagging indicator, but right now, talk to any company, they're struggling to find employees. If companies were truly afraid of a recessionary environment, well, they would be putting off hiring plans, and that's not the case. Manufacturing is still strong. Exports are globally on a year-over-year basis are still positive. So we're not in a recession. Could we be in a year's time? Well, sure, we could. That's not my base case right now, but we do know when the Bank of Canada raises rates, when the Federal Reserve raises interest rates, it slows economic activity. The lag between the Bank of Canada raising rates by 75 basis points Wednesday and the impact on the economy can be anywhere between 6 and 18 months. So, yes, we could be in a recession in 12 months' time. I have no data to suggest that is the case or is not the case. So, for the time being, I will acknowledge that yes, the US economy, Canadian economy, global economy is slowing, but it's slowing from a very rapid pace to a more moderate pace. It remains to be seen if economies actually start contracting. So, I remain a glass half full individual from the economics perspective.
Thank you. Now, one of the key things, Philip, that you have brought to the table, and you just started, and I think you're on episode 8 or 9, is something called the living market, where it's about a 7 or an 8 minute discussion on various topics in regards to the market that people can listen to your podcast, continually be informed. I mean, consumers and investors are more educated today than ever before. And I find your podcasts are very, very relative and very informative. So maybe you can just talk a little bit quickly as we go into closing on your podcast and having that long-term perspective on your financial plans. It's not something that you're taking all this money out at once, and the markets always go up and to the right. Markets are up 75% of the time, and stay invested. Don't let emotions take over and derail your plan. I'll turn
Exactly.
it over to you.
Yeah. First, I'll say thank you for the mention of the podcast. Is something that we're very proud of, and I think it's a great way to communicate with clients on a weekly basis for those that want to just hear our opinions. It is we're targeting a 5 minute give or take podcast on what is what we're thinking about the markets today. We've covered oil, we've covered the Canadian dollar. In the next one, I will be talking about what a recession actually means and how we should be treating it in the context of markets that are already down 20%. And so it's you can find us wherever you access your podcast, for those that like and listen to podcasts, whether it be iTunes, Stitcher, Spotify, Google Play, and so on. With respect to long-term investing, and I'll just close it with this, Brian. I was looking at the numbers today. I like to use the S&P 500 as our benchmark. It's the benchmark for U.S. stocks. If you look back over the last 5 years and think about everything that's happened over the last 5 years, most recently with COVID and the bear market that we saw there, the global economy was shut down and remains shut down. Now, China continues to shut down parts of its economy. And so that we went through that. Before that, or during COVID, I would say, we had a very contentious U.S. election that resulted in riots on Capitol Hill. Before that, we had multiple trade wars. between the US and China, US and Canada, and US and other areas around the world, that was resulting in a direction that we were headed towards a recession in 2019. Before that, we had a deep correction on the S&P 500 in the fourth quarter of 2018. And then we go to 2017, where we had the third North Korean nuclear crisis. So there's been a lot to digest over the last 5 years. And if I had told you that that was going to happen in the next 5 years, you would think, by golly, the markets are going to really, take a beating. Well, over the last 5 years, the S&P 500 has averaged a return of 9.5%. It doesn't feel like it because of what we've just been through over the last 6 months. But to your point, over the long term, the markets are still up at an attractive level. 9.5% is something that we should be happy with, and we could look forward, I think, to similar returns over the course of the next 5 years. And I guarantee there will be additional bumps in the road.
Yeah, that's just investing and what takes place. Philip, I can't thank you enough, and I'm so proud that IG Wealth Management has brought you into our fold, into our family, and your leadership skills, and you rounding out a team around you is going to benefit not only the consultants through proper education and understanding of markets, but also bring huge benefits to our clients as you work with the iProfile and using your expertise on those market activities that way. So I want to say, on behalf of my clients and investors throughout Canada, a great big thank you for taking time out of your very, very busy schedule. And I look forward to having future conversations with you. Thank you so much.
Likewise, Brian, thank you for having me on.
Right on. Thank you. Have a wonderful day.